Good morning, everyone. I'm Seth Dennison, Managing Director of Investor Relations here at OptimumBank. And that was an incredible first panel. Very much appreciate everybody's participation in the first panel. And now the second one is going to be of equal stature. Second panel is titled Inflation's Impact, Aligning Monetary Policy with Banking Investment Strategies. Today, we have the privilege of hearing from a distinguished group of experts who provide invaluable insights into how inflation is influencing both monetary policy and investment strategies. Our esteemed panelists include Jim Bianco, a highly regarded market analyst known for his deep understanding of macroeconomic trends, Rebel Cole, a professor and expert in banking and financial markets, who brings extensive academic and practical experience, Tavi Costa, a respected portfolio manager and market strategist, recognized for his unique perspectives on macroeconomic themes, and Nathan Stovall, a leading expert in banking research who offers keen insights into the intersection of policy and banking. Moderating today's discussion is Albert Dotson Jr., whose expertise in law and finance will guide our conversation. Please join me in welcoming this exceptional panel as they explore the critical connections between inflation, monetary policy, and investment strategies.
Albert, I think you're muted.
All right, so we're like 4 years past the pandemic, and muting and unmuting is supposed to be something that we do intuitively. And thank you, Nathan, for noticing my lips moving and no sound coming out. If you were listening to the prior panel, the conversation was absolutely amazing. And they touched on some of the topics we're going to touch on today, but I want to join my prior moderator in thanking Florida Atlantic University and OptimumBank for pulling you all together and hosting this conversation. So what I'm going to do, I'm going to start talking about inflation forecasts, economic indicators, and employment indicators first. We'll give each of you an opportunity to share your thoughts on the first few questions, and then we'll come back and have some specific questions directed at you individually. So first, on inflation forecasts, what are the key indicators that you are focused on to suggest where inflation is heading over the next 12 to 18 months? And I'm going to start with you, Jim.
Thanks, Albert, for having me, and thanks for having me on the panel. Let me just say off the top, when it comes to inflation, I am of the opinion that we hit a cyclical low in inflation in 2020. Coming out of the pandemic, we're going to have persistently higher inflation. We'll develop those theories out a little bit later. But to your question about the indicators that I'm looking at largely at wages and a lot of wage measures that we see. I do think that what we're seeing in this economy is that the shift is moving from management towards labor. Labor has a lot more power to demand higher wages, and we're seeing that along the way. The other thing I've been looking at on the goods side has been shipping costs, shipping delays, and any kind of measure of, say, bottlenecks, because that seems to be the biggest driver right now of goods inflation. And unfortunately, we're starting to see more of those bottlenecks starting to appear. Not as bad as we saw in 22 when we had all of those ships off the port of Los Angeles stocked up waiting to unload. But it's definitely not something that we would refer to as normal. So labor and basically shipping costs would probably be the two that I would start off with highlighting.
Dr. Cole? See, there's someone else muted. I love it. It's not just me.
Me too, yeah. I'm looking at oil prices. Oil prices are currently below $70, which is very bullish right now. But with the current situation in the Middle East, in Gaza and Iran, and Yemen, we could easily see oil prices spike back up to $100, which would be very inflationary as we saw back in the 70s. I'm also looking at the labor markets, looking at employment for clues to what's going to happen to wages. As Jim said, wage inflation is one of the primary things we're going to be looking at. Those are probably the two major things I'm keeping my eye out on, as well as commodity prices in general.
Got it. Tavi?
I think the difficulty of having of sharing your thoughts as one of the last ones is that most of the folks that are smart here already shared some very important indicators. So I'm going to try to share something that I think it's important as well, but it hasn't been shared. I am paying very close attention to the U.S. dollar. It's remarkable that in 2021, when inflation was surging, the dollar was actually strengthening as well. I am very concerned about the US dollar. To me, reminds me when I looked at the 1919 Spanish flu and started to have very high conviction on inflation. And then it started to look at treasury issuances and had a very high conviction on yields moving higher. I'm not here to say I got everything right. I definitely didn't. But this reminds me a lot of that. There's a lot of signs to me that the dollar weakness is likely ahead of us. And the reason why that matters is particularly when you're running a twin deficit. And I'm referring to, yes, it's normal to run a twin deficit if you are the reserve currency, but it's not normal to run a double digit one. And we're now, to Jim's point regarding freight costs and imports are actually starting to become a problem as well. And so I would add that to the inflation camp. I think that's likely to become more and more a problem. And as the Fed is in my view, I love the obsession on labor markets and inflation, but in my view, the real problem here is at the end of the day, for the next 12 months, maybe 2 years or so, will be the interest payment issue. And I just don't see a route out of significantly rate cuts relative to other places in the world, which should have an impact on the dollar. That's my main concern on top of the twin deficit. And so I would think that that's going to add to the inflationary trend. Commodities obviously will play a role there. Somebody talked about the crude, and you look at the long positions on crude today, or I should say in WTI, one of the lowest we've seen in a very long time, over a decade. So clearly that's a contrarian view. Not a lot of people expect inflation to really come back, to resurgence of inflation being a real issue. And I'm very concerned about that.
Thanks. So Nathan, Tavi says that everything's already been shared with those who are viewing, but I suspect you have some thoughts about that question.
Well, I certainly agree with everything that was said. And as Jim said, we spend a lot of time looking at the labor market and the consumer in particular, we're a consumer-driven economy, and looking at things like wages and, can they keep up in the face of inflation? And thus far, we have seen that slightly exceed, as we heard in the last panel. One of the things I'm just looking at is spending and what is actually driving that. The consumer was really held up in no small part through a lot of stimulus through the pandemic. They accumulated nearly $2 trillion excess savings, but those have been exhausted. And a lot of the spending is really held up due to cards, growth in cards. And our savings rates have come down considerably. It's not to say the consumer isn't saving, but we're effectively borrowing a lot to prop up that spending. It's not to a place that I'm really, really that worried. One of the things, while car growth gets so much attention, one of the reasons the consumer hasn't really run out of gas is that they did what corporates did, an extended duration when rates were low. Our biggest debt service component is our mortgage, and everybody refied in 20 and 21. So while you've seen those other components go up, you've actually seen household debt to income not go to worrying levels. We're about 1.5% below the 40-year average. And so I want to see, is the consumer going to run out of gas? Two other little small components when you look at what has really driven up the inflation numbers. Shelter has been pretty darn sticky. I mentioned the household component in terms of homeowners, but on the renting side, we don't see a lot of relief there. Still not enough supply on the homes, on the housing side. So we don't know how much that actually comes down. And one little tiny one is car insurance, where rates have been really, really high. And one good news there for consumers, it's sort of bad news in the short term. Auto insurance, They have not made money. Auto insurers have not for the last few years. We do think that they will regain profitability this year, which means they won't be able to push as many rate increases going forward. So you could see some easing after near-term pain there.
Yeah, I guess for those of us who are paying car insurance, we know that the profitability had better go up because the rates definitely did. So I'm gonna go back to Jim and Tavi. Both of you mentioned imports and shipping and bottlenecks, and made the reference, Jim, to won't be as bad as 2022. Can you just delve a little bit more into what you're seeing in connection with shipping and bottlenecks, both of you? I'll start with you, Tavi, this time, so he's not last. I don't want to repeat the same error before, and then I'll
No,
go back to you, Jim.
it's not an error. There's no way around it, and there's only a lot of smart guys here, so everybody will share very good insights. I think that the trend that is important, and looking a little bit more longer term, goes back to the deglobalization trends we're seeing, and that's that will be something that will continue to add to the inflation front in a big way. These disruptions in logistics, the Red Sea is one example, but I just don't think that would, a lot of people tend to see these issues very unique in a very unique fashion. And I think they're all interconnected. When you think about inflation and imports of things, commodities to me is a reason why I spend so much time on natural resources in terms of research and deploying capital is because they tend to sort of have these long-term cycles that is really predicated on the capital spending of companies in general. And so, we've had the overspending over the last decade or so, and now we're on the other side of that. So while we may pinpoint into potential triggers that can create logistics and other issues, at the end of the day, in my view, that's the big theme is the lack of spending in natural resources, and the fact that we're seeing the other side of that globalization trend actually reversing will continue to add to the inflation front in a large way. So to me, it's the reason why if we see further rate cuts and further depreciation of the dollar on top of what we have currently, it's not a doom and gloom. I think there's lots of opportunities that come from an environment like this. And it's just that the leadership of the market, in my view, it's not fully, reflecting some of those changes. And those changes take time to reflect in markets as well. And so we've had some of those parts of leadership change in the last 2 to 3 years. Emerging markets did all right, despite the fact that we had one of the longest hiking cycles in a very long time. And so you're starting to see some of these trends unleash. And they're all together. It's commodities, it's emerging markets, it's the weakness of the dollar, it's gold doing very well. So, I would not fade any of these trends. I think they're here to stay. And inflation will probably be, just stronger than historical standards, going back to the deglobalization trends that likely to continue, in my view.
Thank you. And Jim?
Yeah, I'll take it from the production to the transportation side. On the production side, we're going to talk about goods here mainly. Remember, just to put this in perspective, about 25 to 30%, depending on the measure you look at, of the average budget in the United States is goods. The rest of it is usually services. So we're talking about a minority of what people spend their money on. The majority is on services. On the production side, a lot of those goods come from our trading partners, and the one that everybody focuses on is China. And two things are happening with China right now. One, there is a deglobalization wave going on where everybody is trying to friendshore, which means we're trying to move our production to places that are friendlier or don't have as much political friction as China does. Highlighting that is Apple in their move to try and make the iPhones now in India, as opposed to making them in China. And they're actually finding it to be extraordinarily difficult to try and do. It's easy to say, it's very difficult to do. And then if you throw on top of that, if you take a look at what's happening with the Chinese economy, it's in a world of hurt. There's just no way to put around it. The Chinese economy is growing at about its worst levels in the last 40 years, other than maybe the COVID lockdown in Tiananmen Square. This is about as bad as it gets right now. The Chinese stock market is falling. And this is a stock market, I might add, that they have rules that they will jail speculators or brokerage firms that write negative research reports. They will go to jail, and yet their stock market's still going down. And interest rates in China are at all-time lows. So you've got the production side of it, turmoil because of deglobalization, and you've got the Chinese, which is kind of the factory of the world, not in a good place economically. Then you put that stuff on a ship and you start sending it around the world. I do track the IMF port call data, and in the IMF port call data, a port call is how many times a ship comes to port. That is down about a third this year worldwide. In other words, because of problems in the Red Sea and container shippings have to go around the Cape of Good Hope, because of low level water levels in the Panama Canal, which has recently been rising, but yet shipping hasn't returned to normal, it is significantly taking more time to ship something from Asia to the United States or from Asia to Europe. Whereas a typical container ship might do 6 runs a year between, say, Asia and Europe. Just go back and forth with containers. They can only do 4.5 or so. And so all of a sudden, what that suggests right there is you've lost about a third of your shipping capacity because those ships are taking longer. You can't turn them around. That has driven up shipping costs quite a bit. They're up almost double from where they were in January. Now, that gets spread upon everything that's in those containers, but you've just doubled those costs. And in a world where we're worried about whether or not the inflation rate is 2% or 2.3% or 2.4%, when you double the shipping costs and when you have problems at your production end, because either you're trying to move to a friendlier country or the country you're working in China, is having a lot of economic trouble, these things can add up real quick. They can create a lot of goods inflation, a lot of goods problems.
Well, Jim, I'm glad you're not sharing any negative reports in China, because we would not want to have you jailed as a result of that. But I do want to.
That's why I'm saying it from the United States.
That's exactly right. So, Rebel, I want to come to you. You talked about oil prices and crude, and others did as well. Can you delve a little bit deeper into why you're focused on that as key indicators for forecasting inflation?
Well, oil is not muted, am I? Oil is
No,
a
we can hear
fundamental-
you clearly.
Oil is a fundamental feedstock for the production of so many things, and energy prices percolate throughout the economy. So if we see a spike up in oil prices because of unrest in the Middle East, for example, we have, Jim mentioned the Houthis just set on fire 1 billion gallons of oil in the Middle East Gulf, then that's going to have implications for the entire economy and obviously inflation as those prices percolate through the economy and show up in everything that we consume.
So Nathan, I'm going to start. I'm sorry, someone wanted to say something? No? Okay, Nathan, I'm going to start with you. I'm going to ask this question of you, and then each of you will have an opportunity to respond. But I have to say, Nathan, I wrote down your comment about consumers running out of gas. Great play on words there. That was amazing. So we're going to give you another opportunity to share your thoughts about economic indicators. Beyond traditional indicators like CPI and PPI, what alternative economic indicators should investors and banks monitor to better anticipate inflationary or deflationary trends?
Well, there's an old line that banks are thermometers of their local economies, and I look at the U.S. banking industry as a whole. So one of the things is the industry as a whole is a thermometer of the U.S. economy. And one of the measures I really look at is what does loan growth look like? Because companies and consumers borrow when they feel better, and when things get bad, they tighten up, they delever, and that can lead to an economic slowdown. So one of the things we're spending a lot of time on, and we always do, is what is happening to actually loan growth. And it's been weak. And it's been really weak for 2 reasons. Demand is weak, and we actually saw loans contract across the banking industry in the first quarter, rebounded some in the second quarter. I mentioned demand being weak, but some of this, and I should start here, has been driven by banks tightening standards. And one of the things you see heading into a recession is that banks tighten standards because they're worried about a downturn, and eventually they make credit less available, and it comes kind of a self-fulfilling prophecy. The good news there is that we're primarily seeing that in the commercial real estate segment. You know, you wake up every day and you see some headline about gloom and doom around commercial real estate, and the idea that being the combination of challenged cash flows, because you've got things like return to office, challenging office properties, not everything is office, but certainly when you look at properties in center city areas, of those office buildings, retail and multifamily could even be challenged there as well. So you've got challenged cash flows, but you've also got higher rate resets. And you've got a lot of those coming due, and there's a big refinancing need. And we actually just put something out in the last few weeks measuring that, which we think there's about $1 trillion in CRE loans coming due in the next year, and that building over time. So as that paper is coming due, banks are being very careful, and they're facing tremendous scrutiny from the regulators in the investment community. And you're seeing loan growth there really slow. You're seeing okay trends on the consumer side. And it's kind of interesting because even as you see delinquencies rise, you heard just this week at the Barclays conference, some of the big banks saying that they'd like to expand their car portfolios. Again, something that you're hearing a lot of people worry about, car balances being at all-time high. But the banks are feeling okay there. You saw some blips in auto, and so you can see some pulling back there. But if you look at the core economy, C&I is holding up. You're not really seeing much cracks in the armor there. And one thing I mentioned about tightening standards, if you look at the Fed Senior Loan Officer Survey, the last one that just came out, there's some interesting trends there where you're actually seeing the percentage of banks tightening standards decline. Again, you tend to reverse heading into a recession. You're actually seeing the prices on those credits decline relative to cost of funds. Again, you tend to see the reverse heading into recession, and you're seeing demand get better. All of them are still negative in terms of net balance. But if you look at those charts over time, you tend to see the reverse when we head into a deep recession. So that's somewhat good. One last thing that I would say is broad M&A activity. You don't see companies expand and do deals when they're nervous. You know, if you're uncertain, you're not going to take a lot of risk. And there's tremendous uncertainty out there right now with not only the direction of rates, but the election. M&A activity broadly is still weak, but we are seeing some green shoots there, as well as some green shoots in terms of capital raising activity. So those are sort of things I'm looking at, you know, how much risk are companies and consumers willing to take? And I'm not seeing anything that really terrifies me right now.
Excellent. I'm less scared already, Nathan. Thanks. So Tavi, I'm going to ask you the same question about beyond traditional indicators like CPI and PPI. What alternative economic indicators should investors and banks focus on?
Well, I think the yield curve is certainly a more conventional, but should be mentioned here as well. The steepening of the yield curve from a deeply inverted level is something that needs to be in your radar. It tends to cause volatility spikes. It tends to cause recessions, and so just empirically looking, if you're trying to really protect the portfolio during those periods after those deeply inverted levels, and you start seeing the steepening, which in my view is one of the most interesting, also macro trades and out there right now is the continuation of that steepening of the yield curve, especially on long end and the short end as well. Look interesting from both opposite directions, and so nonetheless, I think those are important. The other thing I would mention that it's happening actually right now, and I'm not seeing, I guess, enough people stressing this, but I've noticed, especially in the technology sector, that the breadth of the market is falling significantly. If you look at the 200-day moving average of companies right now that are below the 200-day moving average, that percentage has dropped drastically, and we're still seeing the index of technology near all-time highs. And so That's something to be aware of. And I would point out another one that I think it's very consumer driven, that is interesting too, is looking at the car loan rates versus the 5-year rate. And if you look at those two lines, what you tend to see is that they follow each other somewhat closely, right? I mean, if you're taking a loan on for an auto, and you're taking the risk-free rate, they tend to follow each other somewhat closely, although the car loan rate tends to be higher usually. What is interesting right now is that we had a decline of the 5-year yield, but the car loan rates remain, significantly higher, which I think it reflects as well on some fragility of the consumer. It's from a lender's perspective, that you're seeing the concerns about having to keep rates slightly higher, despite the fact that the risk-free rate has declined. So it's something also to be very much aware. So those are the things outside of that I've been noticing more recently that I think add to the more weakness camp of the economy in the U.S.
The Rebel, before I go to you, I noticed as Tavi was talking about the car loan rates, Nathan, you were shaking your head in agreement. Is there anything that you want to add to his comment on that?
Just think there's real weakness there, and we certainly saw it, this past week with Ally putting out bad numbers that really spooked the market and really kind of led to a broad sell of bank stocks, because really every day everybody's waking up worried about credit risk, and so anytime there's any indicator there, one thing too though is the auto market just had such big disruption during the pandemic, with prices going so high and now coming back down. And the other thing I would kind of say is that it's an unusual market where it's very consolidated within U.S. banks, but there's a lot of credit unions very heavily competing there as well. So it is unusual, but that is the area that I am also concerned with. But the relative exposure to U.S. bank land is pretty consolidated among a few players.
Got it. So, Rebel, you were about to answer the question. Apologize for cutting you off there, to give Nathan a chance to comment more on the car loans. So why don't you share with us, beyond the traditional indicators of CPI and PPI, what should investors and banks monitor to better anticipate inflationary or deflationary trends?
Well, there's several that I'm looking at. First of all is credit card delinquencies, consumer credit card delinquencies. Credit card debt is at an all-time high, and delinquencies are spiking upward. They're not where they were in 2008, but that's telling us that the consumers are tapped out. They borrowed as much as they can, and now they can't pay their bills, and 30% interest rate. Another thing I'm looking at is the NFIB Optimism Index for Small Businesses, the National Federation of Independent Businesses. If you look at the chart, it looks like a total repeat of 2006 to 2008, the way it's falling. Index is just falling off a cliff. This is screaming that we're heading towards a recession. What I'm really focused on, though, is I used to work in bank supervision for Chairman Greenspan at the Fed back in the 90s. I'm focused on commercial real estate and the NPLs and troubled debt restructurings in the banking sector. Troubled debt restructurings have risen by over 100% year over year, and NPLs are up sharply as well. There's a wave of commercial real estate refinancing during the next year, about $1 trillion. Most of these were 5-year balloon mortgages that were originated in 2018, 19, 20, 21. They're currently carrying rates around 3%. They're going to be refinancing at 7 to 10%. These properties are not cash flow positive as that sort of a mortgage, and so we're seeing this wall of foreclosures coming in the commercial real estate space. Now, it's really bad in office because office has been hit by the work from home double whammy, but they also face this refinancing wave. But the refinancing wave, it's going to hit all property types and all geographies. It doesn't matter if you're in Florida, it doesn't matter if you're industrial property, it doesn't matter if you're 100% leased. When that mortgage goes from 300 basis points to 800 basis points, that property is most likely going to foreclosure. And then the problem is that propagates because that property sells. We've seen these properties selling 50%, 70% haircuts. That becomes a comparable sale for appraisers and, more importantly, for bank examiners. So then the bank examiners are going to bank portfolios and saying, hey, you've got to provision for potential loan losses on your commercial mortgage portfolio. So this is all going to percolate through the banking system. It's going to have a very negative impact on access to credit, which is going to, again, pointing towards we're heading into a recession.
Rebel, you and Nathan are equally focused on the commercial real estate market and the challenged cash flow. Thanks for sharing that. Jim, how about you?
Well, I could breathe a sigh of relief because I had a couple of indicators in mind and they didn't get picked off. So I could discuss them right now. Since we're talking about PPI and CPI, I'll go with two. The Institute of Supply Management puts out a survey of purchasing managers, and they ask them a series of questions. One of the questions they ask them is the prices you are paying, your input costs, are they higher, the same, or lower than 3 months ago? That's the exact question they ask. And they put out a diffusion index. So 50 is equal number saying higher or lower. And that is a pretty good indicator from purchasing managers as far as input costs. If you look at they have both a manufacturing survey and a non-manufacturing survey. The non-manufacturing survey would largely be probably wages because you're talking about service companies at this point. Both of those are running at above 50, meaning that more companies are reporting that prices are going up than prices are going down. And that was a very good leading indicator back 2 years ago, 2.5 years ago, that told us that there was going to be shipping problems because it spiked right before shipping costs spiked. And we had those bottlenecks coming out of when we were coming out of the lockdowns with COVID. Now, mid 50s is not a spike. I mean, it went, it could go as high as 100, meaning 100% of the respondents are saying that they're seeing higher prices. It got into the low 90s in 22, and it's in the mid 50s to high 50s right now. So that's not suggesting that there's any kind of a problem, but still more companies are reporting higher prices than lower prices. The second one I'll talk about is a little bit more nuanced, but it's very important for the Federal Reserve. And that's about what they call inflation expectations. And the Federal Reserve believes that this is a big driver of inflation. If you believe inflation is going to be higher, you're going to change your activities accordingly. So one of the measures they use in inflation expectations is the University of Michigan Consumer Confidence Survey. Within that survey, there is a question that they ask, what is your outlook for inflation over the next 5 to 10 years? Now, this gets widely reported on the median expectation for this survey, which has been really steady at around 3%. And a lot of people on Wall Street have said there isn't any inflation problem because it isn't moving. The median has been holding 293, 293 for the last several months. But the University of Michigan on their website for their consumer confidence survey do publish, because it is a survey, a bunch of crosstabs. And if you look at the standard deviation, the mean, if you look at the interquartile ranges, in other words, within the data, what you're finding is there is wild disagreement about where inflation is going to go. The top 25% answers are just shooting off the top. You're getting some of the highest readings in the 45 years among the top 25% that we've ever seen. The bottom 25% are getting worried we're going to have deflation. So the median doesn't change. This is basic statistics here, but the interquartile range has been expanding greatly. And what that suggests is under the surface, there is no agreement at all as to where inflation is going to go next. This weighs heavily in the Fed's decision-making process when it comes to looking at inflation. Now, they're ignoring it for now because they're getting set to cut interest rates. But this will be a problem, I think, if it continues like this. And by the way, this whole disagreement, this is within the last 5 to 10 months. So this is not something that's been around for a while. So purchasing managers, prices paid in the University of Michigan survey on inflation, 5 to 10 year outlook.
Jim, when you first said that you had a few indicators that others had not mentioned, I thought maybe you're going to go to headlines. The headlines today are all over the place, including most recently that inflation is falling. In the last day or two, the headlines are suggesting that, and the inflation expectation might be influenced by many of these headlines, but we will see. And for those of you who are paying attention and you heard the reference to the University of Michigan, go blue. So I'm gonna skip over the employment indicators just for a moment that I said I was gonna go to. And since you mentioned the Fed, I'm gonna ask you a question about inflation targeting. You know, considering Chairman Powell's comments from Jackson Hole last month, how does the Federal Reserve's current inflation targeting approach align with the broader goal of maintaining economic stability? And will this approach be sufficient given current economic indicators? So, Tavi, I'm going to start with you.
Okay, well, I think that this mandate of the Fed is becoming more and more challenging, although it appears to be becoming easier. I actually think it's likely to be almost impossible. If I'm right about inflation actually staying higher for longer, and what concerns me, and I know some people have mentioned this as well, is the interest payment relative to GDP is really eating into the fiscal stimulus. And one of the things I think a lot about is what caused this exceptional valuation of U.S. companies versus other places in the world. And I cannot think of anything that tied this more outside of technology than the exceptionalism coming from the fiscal stimulus that we've had in the US versus other places. And when you see the interest payment starting to become 70% of the deficit, you have to wonder what the policy will look like from a Fed standpoint, from a fiscal standpoint. If we all agree here that the fiscal side doesn't have really a choice of continuing to or to actually create any sort of austerity or a plan to reduce the deficit problem, then we have to think about with the lenses of the Fed. What would the Fed then, mandate look like in the following years if interest payments are really eating into the spending of the government? And in my view, it comes down to the suppression of rates. And we don't know what policies will look like. History helps. And 1940s is a good example of that, of actually having to run primary budget surpluses and trying to suppress rates and all sorts of mechanisms that were used at that time. We can go back to the British Empire back in the early 1900s, restructuring the debt. All those are more radical changes. So none of us know what exactly will look like, but that me goes back to the mandate of the Fed, because I think that the Fed is, this inflation and labor markets, stability mandate is going to be challenged by the fact that the interest payment will become more and more relevant discussion and actually merging the fiscal and the monetary side of policy in a big way. So I know this is a big answer, but I think it has a lot of implications in markets. I can't think of a world where, if we do see something along those lines, that hard assets won't perform very well in that environment. So I'm constantly thinking about this as well from that perspective. So that's my 2 cents on the mandate.
Excellent. And for those of you who are watching the same screen that I am, it appears that Tavi is frozen and he's not practicing ventriloquism, just so that you are aware.
That's not good.
Rebel, I'm going to give you an opportunity to also share your thoughts on inflation targeting and the current approach.
Well, we know that the Fed has a dual mandate. They focus on inflation, they focus on employment and labor markets. We've heard Chairman Powell and other members of the FOMC say that they're switching their focus to the labor markets. And I'm wondering if this is premature. Does Chairman Powell want to be the next Paul Volcker, or does he want to be the next Arthur Burns? Remember that Arthur Burns back in the 70s famously started cutting rates too soon and let the inflation genie get back out of the bottle. And then we had Paul Volcker had to come in and raise rates to above 20%. We know that Powell failed to act on inflation during 2021 because he was seeking reappointment, which he achieved in April or May of 2022. Will he cut rates in September, 6 weeks before presidential election, and thereby politicize the Fed, as we've seen happen in the Supreme Court? It sure looks that way. Do the economic numbers indicate that the Fed needs to cut in September? No. Could they wait till December? Yes. So it's going to be very interesting. And the Fed also has multiple levers in its quiver. It doesn't just work on the Fed funds rate. It also has its balance sheet, and it had been cutting its balance sheet. I'm not sure where it is now, but I'm old enough to remember when the Fed's balance sheet was $800 billion, and last I checked, it was around $9 trillion. So it'd be interesting to know where is that going as well.
Thanks, Rebel. Jim?
Yeah, so the Fed's target of 2% might be getting a problem for them. So let's go back to May of 2022. Jay Powell was in the White House at the invitation of President Biden. And President Biden, this is back when the inflation rate was over 8%. And President Biden literally pointed at Jay Powell and said, America, this is the guy that's going to fix the inflation problem. Don't blame me, blame him, is basically what he said. And since that day, the Fed has taken it as an article of faith that they have to get the inflation rate down to its long-run average or their long-run goal of 2%. Now, what's been happening with that is there's been a big debate whether or not the Fed can get it down to 2%. And there's good arguments that maybe they can't. I happen to be in the camp that they can't, that they might be able to get it to 3%. And that is a big difference between 2 and 3. But the Fed almost can't entertain that idea that they can get it to 2 because it would be almost admitting failure. So they keep talking about getting it to 2%. That brings up another issue. If the long-run inflation rate is 2%, where is the neutral funds rate? When they start cutting interest rates next week, as I like to say, they're going to start a journey. What's the destination? The destination is neutral. What is neutral? If you ask most people on Wall Street where neutral is, they think it's somewhere between 3.5% and 4%. I happen to be more closer to 4%. The Fed's official target for neutral is 2.75%. That's up from 2.5%. And in June, when they raised that target to 2.75, Chairman Powell was asked about the long-run target going up to 2.75, and he completely dodged the question. Oh, it's kind of a theoretical exercise, a thought experiment. Those are the words he used. It's not, don't really look at it as much more than that. Well, why is that important? Because if the Fed is going to start cutting rates and they're anchored on this 2% target, and so they think that the neutral funds rate is 2.75 to 3, they're going to cut rates 10 times, 10, 25 basis point cuts in the next year or so, and that's what the market's pricing. We have to ask ourselves a question. Is that going too far? Are they going to go so far and stimulate so much that they're going to produce an inflation problem on the other end? As Dr. Cole talked about, are they going to be, produce the same mistake that we saw Arthur Burns do in the 1970s when he cut rates too much, too fast, and then we had a secondary echo of higher inflation? It'd be one thing if the Fed were to cut rates to 4%. It'd be about 525 basis point cuts and hold there. But it seems like they're getting ready to go to this, target of 2.75 because they can't let go of this 2% inflation target because the president ordered them to do this in May in 2022. And they take that very seriously because it's one of the mandates of the Federal Reserve. So this inflation target thing is becoming a real issue for the Fed, and how they're going to work this out over the next year is really going to be important for financial markets and the economy in general.
Thanks, Jim. And Nathan?
I think those are all really good points. And the only thing I would add there is that I think the futures market has been a little aggressive. While the Fed has made the comments as Jim just outlined, and they're basing it's not based on nothing where they're forecasting where rates would go. But if you look at late last year, we thought we had 7 cuts this year, and we thought we'd be there about now. We're not there yet. I think if you've heard some of them talk, FOMC members, I think they are familiar with the 70s and worried about it. So I've always thought, I've been in the camp for some time that I thought that maybe the market was getting ahead of itself on the pace of cutting, and that they were going to be more focused on killing inflation rather than worried about the economic impacts. I know that flies in the face of some of the statements that have been made from the Fed, as that Jim just really outlined. But the last point I would make there, I think Jim laid out a pretty good case of why it would be challenging for them to kind of meet the level of cuts that some people are expecting, given what we've seen from inflation over the last 6 months.
Excellent. So I'm now going to go back to the employment indicators that I suggested to you I'd be discussing at the top of this discussion. With the updated BLS report indicating 820,000 fewer jobs than previously assumed, how does this impact the Fed's approach to monetary policy? And what are the potential implications for inflation forecasts and interest rate decisions? So, Dr. Cole, I'll start with you.
It's interesting, we have this revision, annual revision, where they say that 800,000 jobs actually weren't added to the economy. But that was really no shock for those of us who follow this, because just about every single jobs number that we've had in the last year has subsequently been revised downward, sometimes quite substantially. So it's not a surprise that when they finally do this benchmarking, we find out that a lot of those jobs didn't exist. One thing I really look at very closely when the employment situation comes out each month, first Friday of the month, is you get this headline number of 150,000 jobs. But then I immediately go and look and say, okay, how many part-time workers were added? So if you had 500,000 part-time workers, but only 200,000 jobs, then that means we've lost 300,000 full-time jobs. And that's really bad. And that's kind of what we've been seeing some in the recent reports. Another thing I like to look at is the number of workers holding multiple jobs. There's 2 surveys in the employment report. There's the household survey, which surveys households, the establishment, which is surveys establishments. We get the jobs number from the establishment report, the unemployment numbers from the household survey. But the household survey also has numbers on workers, and it doesn't count these multiple job holders. And we've consistently seen the household survey showing fewer workers than the establishment survey. So these are sort of things I'm looking at when I look at the employment reports every month.
Tavi, how about you?
Yeah, in terms of the labor market, I think it's very tricky to unfortunately be using that as a indication of the business cycle this time around. And the main reason is because we can't ignore what's happening with immigration. Immigration is really changing how that data will look like. I mean, usually when you see the unemployment rate crossing its 24-month moving average, it's always been the case that we've had a recession and a further deterioration of labor markets. Now, I take that with caution because I really don't know if labor markets is the best way, most accurate of being looking at the economy. Now, one thing that I would point out, that despite what's happening with immigration, will probably be seen as weak data for labor markets, is the fact that when you look at further into the job openings in the U.S. and you look at how much of that is coming from government jobs, that trend is moving higher, and that's at the highest levels we've seen in many years. Usually, when you get to these levels, you're getting into a recessionary period. So yeah, that's a concern. I think that's something that maybe immigration might not be playing as much of a role into that data as other things. And so that's one other point. And then the other thing I would point out as well has been this lagging effect on the tightening cycle that I still respect, at least. we can come up with why this time is different and all those sorts of things, but you have to at least it's the same thing as the yield curve. As an investor, you have to be at least cognizant of those things developing, and one of them is the fact that when it takes time for the hiking cycle and interest rates to actually permeate into the system, not only on corporate bonds and the actual cost of capital overall, but also particularly when you're talking about reissuing debt. And a lot of companies, as we know, have really levered up. I mean, I'll give you one example: the consumer discretionary sector, which is a very large part of the economy, as you all know. It looks to me, I don't think I've ever seen that sector as levered as it has been from a debt to assets perspective. And so you would think that the reissuance of those commitments will eventually tight the cycle overall, and I think that will have an impact in labor markets at some point. So labor markets is the only thing in this discussion that I take with a little bit of less of a conviction because of this immigration trend. But I think there's some things to be, as I pointed out, to be aware of and to be concerned about, that are important to emphasize.
Jim, you started us off talking about labor markets, wages. When in response to my first question, I'm going to go to you to see what your thoughts are about this issue of the BLS report.
Yeah, I think Tavi hit the nail on the head. It's really about migration, and it's really about the population growth of the country. If you look at, let's start with the big picture. If you look at the population growth of the country, it has been declining, lower fertility rates in the United States for decades, and it bottomed at about 0.3% a year in 2020. It has now exploded higher to a 20-year high. Population in the United States is now growing at about 1.15%, or about 3.5 million people a year. 80 to 90% of that population growth is coming from migration. It's not coming from some kind of baby boom in the United States. And why is that important to bring up? Is because all the labor data that we look at is based on surveys that are adjusted for the population, and it's based on tax returns of people that have jobs with withholdings. If millions of people are coming into the country that are getting what the BLS refers to as under the table jobs, then it's really starting to wreak havoc on a lot of the labor data that we're starting to see. I'll channel my inner Goldman Sachs here. The 818,000 jobs that we saw being revised away, they estimate, and I think they're right in their estimates, that it was really only about 300,000 jobs that got revised down. The other 500,000 is that we replaced people that were getting jobs with withholdings with people getting paid under the table. So when they looked at the tax returns and they saw that people were getting more unemployment insurance and less people were paying into unemployment insurance, they assume that means that those jobs never were created in the first place. If the population growth of the United States was stable, that would be a good assumption. But because the population growth of the United States has been exploding higher for the last couple of years, it is a questionable assumption. That is also showing up in the unemployment rate too. One of the things that's happening with the unemployment rate is they do a survey of 60,000 households for the household survey, and they ask, how many people are working, how many people are looking for a job, and then they adjust it by the population growth. And because we've had this massive population growth in the last 4 years, it's showing up as higher unemployment rates. But don't confuse that with companies are hiring less people. That's why you see in the payroll report, we're still well over 100,000 people getting hired every month. Economists think that prior to the population growth spurt, we only needed about 80 or 90,000 jobs a month to meet demographics. But now because of the population spurt, we're going to need like somewhere between 170 and 220,000 jobs over the next few years. Well, in order to get that level of job growth, you might have to stimulate the economy into a recession, into an inflationary push. This is the real problem. And I'll just leave it with, it all comes back to the population of this country has dramatically changed in the last 3 to 4 years. And it's permeating all the statistics. I might just parenthetically add that I think you're seeing that in the housing data. Most of the housing data looks very weak, whether you're talking about sales, affordability, except prices of homes is continuing to make new all-time highs. Why? We've got 7 million more people looking for a place to live in this new country. And it's really putting a strain on the housing stock, which is why prices aren't falling, even though everything else is falling. It comes back to that change of population growth. It's really driving a lot of the statistics we're seeing. And you question whether or not the standard definitions of, well, the unemployment rate's going up, so that means no one's getting hired. The revisions of 818,000, that means there's less jobs. That means that the labor market is weak. The Fed must respond by cutting rates. If that's really the right prescription and the right interpretation of what's happening, given this change in population growth.
Nathan, in response to my first question, you spoke about housing. Yeah. So I'm going to give you an opportunity just to react to Jim's comment there, and then talk a little bit about the BLS report.
Yeah, I mean, just one thing on housing is that the supply stock there is still really low. One of the things that happened in the aftermath of the Great Recession was we had overbuilt massively leading into it. So we had this massive inventory of homes we had to work through. And it took us a lot of years to do so, 3 or 4 years. But then we effectively underbuilt in the housing sector leading all the way up to the pandemic. So there is still a lack of supply, particularly when you talk about entry-level single-family homes. So, I mean, I think that's one of the things that I think has helped hold up home prices across the U.S. But I think Jim's point and Tavi's point about how messy this data is really underscores how difficult the Fed's job is. The unemployment data has been distorted, as Jim just outlined, I think, quite well. And what is the right sort of health of the labor market and how tough that is. And as Tavi talked about, the idea that the impact of higher rates hasn't really played out the same way we've seen historically, because I mentioned this at the opening, what we saw with consumers extending their duration with mortgages, but also corporates doing so in 2021 when rates were so low. It's not to say that it won't come, but effectively it's delayed the impact even further. So I just think both their points really underscore just how tough this is when trying to look at historical periods.
Got it. And since you're speaking, Nathan, I just want to go to the monetary policy limits. Excuse me. It's been touched upon in the answers to some of the other questions, but maybe there's more that each of you would like to share. Like, what are the limitations of monetary policy in addressing inflation, and how should economies prepare for potential policy failures? So Nathan, I'll start with you.
Well, I just talked about some of the limitations, but the idea that the Fed sets rates and the banks are effectively the engine of how that carries out. And so when you have lots of people who borrowed when rates were low with fixed rates, you've effectively kicked out how impactful that can be on terms of tightening monetary policy. Here's the thing, the flip side of that also means how impactful they'll be in terms of lowering rates. So if you get a couple of cuts here, how much actual relief and impact does that actually have on the economy? And we think it's going to take a while on the way down. We talked about commercial real estate earlier, but I mean, the idea that, a quarter point cut changes anything there, I don't think so. I think you'd have to see dramatic cuts for that to look different. But I also think you have a lot of fixed rate debt outstanding right now. So even if you get rate cuts in the near term, that it will not come anytime soon. So, how do you prepare for that? I think be aware of that. And I think understand that, there's an old line in bank land, don't make rate bets. Don't sit there and wait on the Fed cutting to actually change the health of your portfolio and the health of your balance sheet. Certainly keep your eyes open, but understand the limitations here.
Dr. Cole, how do you feel about that?
Well, you have to consider monetary policy working hand in hand with fiscal policy. The Fed simply cannot control inflation when we have massive and reckless fiscal policy, as we have had for the last several years, where we're running $2 trillion a year annual deficits. So it's like a race car. You're putting your foot on the brake and on the accelerator at the same time. The Fed is, their hands are tied when this happens. And then now we have a situation where the Fed is contemplating cutting, but as I say, we're running these massive fiscal deficits, which are incredibly inflationary and expansionary. Is it really the right time to start cutting rates, given that the accelerator on fiscal policy is down pedal to the metal?
Jim, you want to react to that?
No, I think Dr. Cole's got it exactly right that you cannot exclude fiscal policy. And with the amount of spending that we're seeing and the deficits that we're seeing, that I like to, Wall Street is having this conversation about whether or not we're having a recession. And I always like to say, no, we can't with this kind of level of fiscal spending. At least a recession is defined as seeing negative GDP growth or some negative numbers that they will single-handedly create enough economic activity to prevent a recession. Fear, of course, is that they're going to create inflation along the other side. So it's not just all good and nothing bad. But the other limitation of monetary policy is, as the Fed likes to say, it's a blunt force tool. They can cut rates, but they're going to cut rates for everybody. And this really comes into with the housing market. I talked to a number of people in the housing market, mainly mortgage brokers, and they usually scream and yell and throw tantrums that, interest rates are too high and they can't get deals done because the monthly price or the monthly payments that people have to pay are too high. They absolutely need the Fed to cut interest rates. Okay, well, the Fed can't cut interest rates for mortgage brokers. It has to cut interest rates for everybody. And that means they're going to be cutting interest rates in the corporate bond market and probably in the high yield market. And they're going to impact valuations in the stock market at the same time that they cut interest rates. And the totality of all of that, does that produce the outcome they want? They might satisfy the mortgage broker, but if they wind up creating a giant wealth effect in the stock market with lower interest rates, and they create a boom of corporate borrowing, they could wind up overheating the economy at the other side. So we got to keep in mind that I hear this all the time when people talk about the Fed should cut rates. And then I hear, because here's some narrow part of the economy that needs it, mortgages right now. Okay, they do. But they can't just say we're going to cut mortgage rates only and nobody else's rate. They cut everybody's rate or they cut nobody's rate. And there is the limitation of monetary policy.
Tavi, it's great to see you.
Good to be back.
Yes.
So
Your thoughts?
I think that the limitation on the Fed front is interesting, just because the mitigation of inflation, of raising rates in an environment where I just talked about the interest payments really eating into the spending on the fiscal front is really prevents the Fed to do anything about it. And so the Fed has a choice to make, and given what the labor data is presenting to them, although I gave you so many and everybody else gave so many caveats on the immigration front and other things, the Fed may as well use that as a card to justify its actions. When I look at the 2-year yield today, I think we're going back to 2%. Now, this whole idea, and I know these are not T-bills, the whole idea of T-bills and chill that some of the media and investors were talking about maybe a year ago, I am very, very much of that view today. I actually think that that's a very interesting way of protecting your portfolio if you are of the opinion that 2-year yields, especially in other yields, are going to drop significantly. It would not surprise me to see 2-year yields back to 2%, which is a very, very significant change from where it is currently. Another thing that I think reflects on the Fed limitation of fighting inflation, but also the divergence of policies between the Fed and the fiscal side, look no further than the central bank assets chart versus money supply. Money supply has been resurging recently, and at a time when we're still seeing the QT, the depletion of reserves occurring in the Federal Reserve balance sheet assets. And that's again a reflection of the system that doesn't allow that type of monetary tightness, that through the fiscal stimulus as well continues to add to that money supply front. And, this is why I think it's very difficult to wear a deflationary hat in this environment, because, the the limitation as well from the macro imbalance that we have historically on the debt front, doesn't allow the Fed to truly fight inflation as it probably would in a normal cycle as well. So again, it's almost, the end of the day, it's almost like we tend to see more and more monetary suppression, and the translation of that is on the data by looking at money supply resurging, and others. And so, this is why I think an inflation camp remains, in my view, underappreciated still. And it sounds crazy. I mean, how can you have an inflation view with 2-year yields falling? No, I understand, but I think it's very possible to see that in the next 12 months or so. And so I'm of that view.
So Nathan, you suggested at the top of this that consumer spending was one of the factors we should be focused on over the next 12 to 18 months. So tell us a little bit about your thoughts on consumer behavior that we should be focused on that could typically lead to inflationary versus deflationary impulses. And what have you seen from the U.S. consumer in the last 6 to 12 months in that regard?
Well, certainly the consumer is stretched relative to where they were a year ago. And I mentioned the idea of looking at savings rates. You've seen those come down considerably. They're not at zero, but it definitely is worth looking at, and also maintaining a focus on wages relative to inflation, as Jim talked about earlier. So the fact is they are still saving some money, but as I mentioned, they're relying on cards in no small part to maintain some of that spending level. Rebel talked about this earlier. We are seeing delinquencies on cards go up dramatically from historical lows. We hit a trough, I think, in October of 21 when you look at the major card issuers there in terms of delinquency levels. But two things I would point out. If you look at what the pre-pandemic average was in those delinquency rates, we haven't hit that yet. So all those card companies will tell you that this is more normalization. The jury is still out there. But the other thing I would say, in Q2, we actually saw a sequential decline in those level of delinquencies, and that's the first time since early in 22. That doesn't really speak to a consumer getting really out of control and really, really over their skis. Still a little bit early, but stabilization, I think, is pretty encouraging there. And one other thing I would note too, we heard from Bank of America this week, one of the things they do is they look at not only their consumer spending, but the balances that their consumers keep in accounts. And remember, they hold 10% of the nation's deposits. So they have a decent window into what that looks like. And Brian Moynihan had said, it's down from what it was a year ago, but they've seen some stabilization in the last 6 months there in terms of the level of balances. So they're not drawing down more. So early days, it could get worse for sure, particularly if you see the labor market weaken, but somewhat encouraging trends there in terms of stabilization.
Rebel, I'm going to ask you a different question focused on credit risk management, since Nathan really invoked that from an earlier comment that you made. So how has inflation affected credit risk over the last 12 months, and what do you expect to see over the next 12 to 24 months?
Well, before we go there, I did want to jump in on consumer behavior because of a story I saw on the financial networks a few days ago. The stock price of Dollar General is down almost 90% this year after skyrocketing during the pandemic. So what does this tell us? It tells us that those at the bottom of the economic ladder are tapped out. Inflation has ravaged those people at the bottom half, but it's done little to hurt those of us at the top. All right, so now credit markets. We're starting to see the impact of inflation and its impact on the economy enter into the credit quality of the banks. I've already mentioned the rising troubled debt restructurings and non-performing loan rates at the commercial banks. The non-performing loans, they report them in several buckets. One of them is 30 to 89 days past due, and then there's longer term. And that 30 to 89 day bucket is what I keep my eye on. And that has been rising much faster than the total NPL ratio, which tells us that the situation is getting worse in the commercial real estate market in particular, but not just in the commercial real estate market. I also mentioned what's happening with credit card delinquencies. We're seeing, the fact that those at the bottom half of the income level, they got the big COVID money from the government during the pandemic. That dried up. They maxed out their credit cards, kept spending. Now they're unable to service their credit cards, and that's showing up in delinquencies, which tells us that they're tapped out. And that has some very negative connotations for what's going to happen with consumer spending going forward. But it also has implications for what's happening in the credit markets as far as credit quality of these credits. So I think we're going to see a lot more deterioration in bank balance sheets during the coming year, and that means they're going to be clamping down on credit, because when they have high NPLs, then they have to provision and they can't lend.
Tavi, if you want to comment on the consumer impact and credit risk management, you may. But I'm also going to give you another topic to focus on, since you began discussing the U.S. dollar and imports earlier on in the discussion. And how does inflation impact investors differently in emerging markets compared to developed economies? So you can take any one of those three topics. Just want to get your thoughts on that.
Well, I'll take the emerging markets because I think it's such an important, trend that is not also have not been impacted in markets just yet. And AI leveling the playing field from a labor quality standpoint is a very important deal. That when you think about this differential evaluations of companies in the U.S. versus other places I come from Brazil, so I can speak a little bit more specifically about that. It's been very challenging. I mean, the Brazilian economy, South American economies, and other emerging markets have always dealt with inflation. Inflation has never left the picture. So they deal it differently with it, and they're very fast on acting from a monetary standpoint and even fiscal standpoint when it's necessary. Different from developed markets, in my view, that lack a little bit of the understanding of how policies still can add to the inflation front. I mean, this idea of an Inflation Reduction Act and all these things are, to me, classic signs of lack of understanding of inflation in the system. And it's just a reflection of the fact that we just haven't dealt with the problem for many decades. Now, I think that emerging markets present an outstanding opportunity today. And mostly because it's tied to the commodity markets. When you look at the charts of industrial base metals and metals in general, or even energy markets versus specific resource-rich emerging market economies, obviously they're very linked. So if you're of the view of a dollar weakness, which I am, and you're the view of a secular market for hard assets, you're also probably of the view that emerging markets can actually outperform developed markets. And these things, every couple cycles, or I should say every couple decades, they change. The leadership, before the tech bust in the early 2000s was also very prominent, coming from the US. So you had allocation of foreign investors being very heavy in US equities, and then that shifted. And so you look at Brazilian markets from the early 2000s to 2011, they went up 18-fold. The most boring index, Ibovespa, if you just bought the Ibovespa the early 2000s and held it all the way to the end, that was an 18-fold return. These are not small returns. And so, although all of them carry risk and markets change prioritization towards risk in different times, I'm not here to say that, Brazil has been in emerging markets for decades and never emerged to become a developed economy. And that's not just Brazil. A lot of emerging markets have been emerging for decades and never emerged to become developed economies. There is a reason for that. There's fundamental reasons that don't allow those economies to change that profile. But when it doesn't preclude investors from making money on assets that could, take on that leadership again. As I said, that cycles change, and every couple decades you have these shifts on, one economy being favored versus another. And so I think we're kind of in that inflection point today in emerging markets. And so hence why I pay close attention here. You have legacy businesses, banks and financial companies that are trading currently at, lowest multiples we've seen in history. So the inflation question you asked, although it's important, I don't think it will really impact the emerging markets, valuation of assets as deeply, just because it's not a new problem. It's something we've dealt with many decades. And so, in fact, the consumer is different. I would even point out even one more thing, if you don't mind. Look at how the investors are created in these places. They're very, very value driven. They're very much aware of cost of capital. They're very much aware of discounting free cash flow and all sorts of ways of valuing companies. In the US, that seems to be thrown out the window for a long time. The growth investing versus value investing debate. It's not even a debate in the last few years. Now, I do think we'll come back as we see cost of capital establishing itself at higher levels than we've seen historically. So there are a lot of important lessons in emerging markets, not only opportunities, but lessons that we need to apply in the US, trying to understand how that will impact markets in a big way. I gave some thoughts already, but I think I could go on and on other ideas that could potentially be changes in this landscape of the macro environment in the US versus emerging markets.
Thanks for that. And I want to be respectful of the time that our panelists have allocated for this discussion, and let our Optimum Bank friends know we're going to run a little bit over, because I'm going to give each of them an opportunity to share some final thoughts for the audience. So, reflecting on today's discussion, what is the most critical factor that banks and investors should focus on in the coming year to navigate the complex interplay between inflation, monetary policy, and market dynamics effectively? So I'm going to go in this order. Since Tavi just spoke, I'll give him a chance to clear his throat, and we'll start with Rebel. We'll go to Tavi, Nathan, and then we'll close with Jim. So Rebel?
I know we're short on time, so I'm going to keep it short and sweet. I've already touched on this. The most important thing to keep your eye on is the interplay between monetary and fiscal policy. These need to be working together in order to avoid recession and inflation. Fiscal policy is stuck in a massive and expansionary inflationary mode. You simply cannot fine-tune an economy using only monetary policy. The instruments are too blunt, the legs are too long. We must get our fiscal house in order, and it doesn't look like either of the parties have any intention of doing that.
Tavi?
I'm actually going to agree. I think that the fiscal side is the most important thing, the most important aspect of everything. Potentially what we could see here, the changes because of the interest payments eating into the fiscal spending to me, needs to be more discussed. And the fact that if you looked at how much that is today, and the conversation used to be, yes, things are bad here, but things are worse outside of the US. And it's not necessarily true, those comments. When you look at the interest payment relative to GDP of the US, running between, 3 to 4%, depending if you want to include local governments or not, versus other countries in the world, sub 2%, that makes me think that the readjustment of the rate policy in the US will likely be more severe than other places in the world. And that interest rate differential, in my view, will have an impact on the dollar. This is why I'm so focused on the dollar, but it ties back to the fiscal ending. So that's my 2 cents on this.
Got it. Nathan?
I'll
Nathan,
build.
actually, before you start, you made a comment when we first opened up that I was muted. And what you did not hear is I thanked David for the amazing introductions that he gave of each of you. And I didn't want to miss this opportunity to restate that so that everyone could hear it. Nathan.
Well, I'll build on those statements and echo what Tavi and Jim had said earlier about inflation maybe being stickier than people think. And what are the implications for rates there that maybe we can't go as low as people think? I think that's something that you need to watch closely.
Got it. And Jim?
Yeah, I'll second that, what Nathan just said, that it really comes down to the inflation rate is much higher than anything we've ever saw pre-pandemic, but it's also the lowest levels that we've seen since 21. And where's it going to go? Are we going to eventually get to 2%, under 2% and stay there? And I might add, do it without a recession. If you have a recession and you weaken the market economy enough, sure, you can get the inflation rate down, but it will only stay there as long as you're in a recession. I don't think we will, but that'll be the big question as we move forward, is where does the inflation rate bottom out and where is it in a year or so? And I happen to think it's going to be around 3%. And I'll just reiterate the other thing I talked about too, and which come up with other panelists, especially with Tavi, is immigration is a big deal. It is impacting the economy through the changing population growth of the economy in ways that we're only beginning to understand now. And we have to be careful of traditional answers. Well, this is happening in housing. This is happening with the unemployment rate. So therefore it must mean, well, we have to start thinking, is it because the population of this country is growing at much higher levels than we ever thought possible, even a year or two ago? Or is it really giving us more of that traditional signal? This is going to be a difficult question to answer over the next year, but it needs to be considered. And we just can't look at this data that is wrapped up with population growth at face value.
Well, gentlemen, thank you very much. Really appreciated this opportunity to discuss these topics with you. And I'm going to now turn it over to Chip LaMarca.